Good morning, everyone. There is a dangerous disease that is spreading on Wall Street. It causes many people to overlook what's clearly in front of them. And you know, someone's been struck when you see them posting just incomprehensible rants about a debt crisis or a frothy stock market. It's not the flu, although that's going around right now, too, of course, but this is much worse, actually. We call it denominator blindness. It's the disease of taking big numbers at face value instead of considering them in context, and it can definitely lead you astray, put you off track. We love numbers. You've been here before. If you've been here before, you know we love data. Data don't lie as far as we're concerned, which is why we lean so heavily into the facts and the figures. We want to see the numbers on everything. But even numbers can mislead you if you don't view them in terms of risk, the R word that we hear all the time, but we struggle a lot to define exactly what does that mean. And when you see those big scary numbers, you need to think, how much risk is there really in the data being given? The most egregious example of denominator blindness in the economy right now is credit card debt. Every quarter, the New York Fed releases a slate of data on the financial health of Americans, and every quarter, like clockwork, the media publishes a bunch of scary headlines on the trillion-dollar mountain of credit card debt that is currently outstanding. And then social media kicks in, slips into a doom spiral, and you get tweets like this one. And this chart probably makes you cringe, which is fair. This is large. This is a huge increase. This is not a graph you want to see as debt increasing. And once it hits that $1 trillion mark, I mean, $1 trillion, that's a lot of money in anybody's book. And it's all on credit cards, which are considered one of the most irresponsible financial inventions of the 20th century. So surely that means that our friends and family are drowning in unnecessary debt. They've been lured in by the capitalism machine and influencer links online. They sell credit like ice cream cones. Everybody's pushing it. And oh, yeah, and the U.S. economy, it's doomed. We are not going to recover from this. There's no way out. Uh, Not so true, everyone. That's what it looks like when you've fallen ill with denominator blindness. Um, any top tier analyst will tell you that you can't look at debt levels in a vacuum. Debt must be compared to the person's ability to service the debt. Otherwise, it's just a number. That's all this is. It's just a number. There's no context here whatsoever. Think of it this way. You've got a friend. Friend's a millionaire, makes high six figures a year in income. Would it be a bad idea for them to go out and blow or borrow 50,000 bucks and borrow a brand new Porsche? Is that going to be a problem for them? Of course not. You know that they have the means to pay off that loan quickly or completely whenever they want. So that number, that increase in their debt level, doesn't add any additional risk whatsoever to their financial outlook. So, you know, why would we do that to the rest of Americans too? Just because we don't know them. If you compare that $1.2 trillion in credit card debt to the total money in the bank, you'll see it's not that concerning. It's 6.2%. It was lower because of our reaction to COVID when we closed the economy. Everybody was paying off bills with stimulus and hunkering down in case we were in the midst of a prolonged disaster, which did not occur. And now we're back up to this significant downtrend, which has been in place since 2005. And it's 6.2% of total assets on deposit. So that number is not that scary. It sounds scary. We crossed the $1 trillion mark. Oh my goodness, isn't that terrible? No, it's not. But you have to have that context to make sure you understand that. And if you're thinking, well, that's because the rich are skewing that overall data, then we'll take a peek at this chart, which is graphing total assets cash, stocks, businesses you own, divided by the total debt. It's excluding real estate. Just this is not taking into account the real estate. So this is a heavily context laden view of public debt, and it shows that American households across all income classes are in a historically strong position to pay off debt, even when you exclude the home equity, which is really high right now because of the crazy housing market. So that would make it look even better. So this is a more honest view. And you can see the 80 to 99 percentile, they have the highest debt level, and it's still at 10% of everything they own. So even that's not bad. You drop down to the lowest cohort here, and it's below 7%. Again, we're down six and change, and then everybody else is down here at five and change. So it's that any way you look at it, the debt crisis is not a crisis. You can look at the big number and try to be scared, or they're going to try to scare you with that number. But when you break it down just a little bit, it's not that scary. And again, this excludes real estate, and so all that home equity is out of this equation. And that doesn't mean people aren't struggling. They are. Inflation has taken its toll. So the affordability of things is a big problem. Income inequality, if you're tracking that, you can say that's a problem. But no, $1 trillion in credit card debt will not single-handedly crash the economy. It cannot. And it's important to remember that all those things can be true. Income inequality can exist, and people can be struggling with inflation, and the credit card debt can be increasing. And that doesn't necessarily mean that's a bad thing, but you need the context so you can see it, because a lot of the financial media is not going to show that to you, and they're going to do everything they can to try to, induce a panic. That same disease is spread to the stock market metrics too. This is a chart of the S&P 500 price earnings ratio, a measure of where a stock or an index is trading relative to the profit it's expected to generate over the next year. And a higher PE ratio tends to show that prices have become disconnected from earnings. And a sky high PE was a warning sign before tech stocks imploded back in the dot-com days. It was, the PE got really high, and then we had a massive collapse. That was not good. So you can imagine people are freaking out over the PE right now because it's nearing a 2-decade high. It's back up at 22 and a half. It's as high as it's been, all the way back to the 90s, to get significantly more out of bed than it is right now. But to judge a market based on the PE ratio is to be blind to crucial information that could actually determine the future path of prices. Because just like credit card balances, rising PEs alone aren't a good reason to panic. You need to look at the price, the P part, and the earnings separately. The numerator, we know prices, but this pesky little denominator down here that we like to ignore, the earnings, is critical in this equation. In this instance, the prices, they're clearly growing. We're coming off back-to-back very strong years, especially in the S&P 500, and investors are assigning a higher value to the future than they were 2 years ago. Right now, people are saying, hey, we think we're in a pretty good spot, and we think we should be growing. And for good reason, because earnings are growing too. The S&P 500 earnings have increased for 5 straight quarters, and analysts expect profits to keep growing at a double-digit rate through this year. So they're growing now. In fact, Wall Street has been underestimating profit growth for the past several quarters, which has led the earnings part of P&E. It's growing faster than everybody expected. It's not growing faster than it should. It's just growing faster than expectations because they've been underestimated. So nevertheless, when earnings are growing, you have to be skeptical of the PE ratio's dubious signals, because when profits are rising, People are understandably feeling good about the future, and the stock market often deserves a higher price. And this is why you'll often see the PE ratio rise at the beginning of a strong market rally, at the beginning of a bull market. It can fall off later, and when everything drops down, and then again when that turns around, prices are going to move higher quickly as the mood recovers, and earnings may take a few quarters to recover. But when earnings and prices are both positive over the past 12 months, so for the trailing 1 year, so these are not like short-term numbers, it's very positive for the market. That's where we are right now. We have higher prices and high earnings, and that tends to be when we're going to get some growth. And we are in that situation right now. And that's good. That's good for all of us. It doesn't guarantee anything, of course, going forward, but it says we're in a good place. So right now we're in the sixth season. Germs can be hard to dodge. Look for those symptoms showing up, though. Look for context-starved panic in things like government debt, the CAPE ratio, which is a cyclically adjusted price and earnings ratio, slightly adjusted for inflation also, but it's a little on the high side right now also, and so that's going to be out there as, oh, look at this, isn't this terrible? Student loan balances, you hear that one a lot. We're doomed. Anybody with a student loan will never be okay. It's just not the case, but you're going to see it out there. Just remember, just because a number is larger does not necessarily make it bad. You've got to look at them in context. But that's not always fun for the person or the company trying to grab your attention. And usually they're trying to grab your attention with the intent of selling you the solution to solve the problem of that big number that they're using to scare you or to confuse you with. So again, it's a marketing tool. It's how to get you looking at things, and it's how to get you to do something because you have to. This number is so scary, you have to do something. And that's the goal. So our message is never get panicked over one number or one metric. You need to take a step back, look at a bit longer time frame, or look at other metrics that also matter to that one being mentioned. Don't look at one number by itself in a vacuum. Another good tip is to look at the percentage of change and not just the number or the dollar value. As just with inflation over time, I remember when it was a big deal when the Dow hit 2,000. Well, that's not such a big deal anymore. So those numbers get larger and larger, but the percentages of those changes don't always change that much. Just those few things, they can really help you keep things in perspective. If something is really bothering you, or you read something and you want to know, well, why isn't that a bad thing? Give us a call. Feel free to ask us about anything out there, any of those metrics. It's fine. That's what we're here for. Give us a call and we can talk through those numbers. And who knows, maybe there's some that okay, we should keep an eye on that. That's a little disturbing. Most of them, though, especially coming out of Wall Street, they're there to disturb you, to try to sell you something. And don't be thrown off track by that. You can get scared out of a perfectly good position or a perfectly good market. And we don't want that to happen to you.